Risk. Enterprise risk. Enterprise risk includes all uncertainties that can affect the achievement of organizational objectives. Among them, legal and regulatory risk and product liability risk are significant because they can lead to financial losses, reputational damage, and even business shutdown. Legal and regulatory risk, meaning legal and regulatory risk refers to the risk of loss arising from failures to comply with laws and regulations, changes in government policies, legal disputes and litigations, non-compliance with contracts. It arises due to uncertainty in the legal environment and regulatory framework. Legal risk is enterprise risk management, refers to the potential of losses, penalties, or reputational damages that arise from legal or regulatory issues affecting an organization. It is one of the major categories of risk that companies must manage along with financial, operational, strategic, and technological risk. Legal risk is the risk of loss due to failure in the legal process. Legal mechanism including confirmation, master meeting agreements, collateral and valuation agreements, loan agreements, and financial covenant are part of most financial dealing. They contain important legal provisions that are designed to protect the parties in the event of dispute or default. For instance, a proper collateral agreement perfects a firm's security interest in collateral pledged on a trade. A proper netting agreement in an appropriate legal jurisdiction that recognizes netting lets a firm manage its exposures on a net rather than gross basis. Failure to negotiate proper documentation or obtain necessary protection in the sign assignments can lead to legal risk losses in the event of default or dispute. If a firm has a portfolio of derivative transactions with a counterparty but fails to negotiate a master swap agreement in some jurisdictions, in the event of default, a bankruptcy receiver may dismiss all contracts with value of the firm, thereby causing a loss. Legal risk can be exacerbated by different business units within a firm handling their own documentation, applying different standards in the process, and by the existence of very large backlogs in getting documents signed. Since many transactions happen before legal documents are finalized, legal departments at large firms are constantly trying to play catch up and reduce the risk generated by such backlogs. It should be clear from the brief discussions above that a firm can face a large universe of risk. These risks can be changed as market products, regulations, and competition change and evolve. As such, defining the nature of risk must be a dynamic process. It is imperative for a firm to continuously review its operations and make sure that it has identified all sources of risk and that manages shares a common understanding of this risk. Formalizing this through regular annual reviews is a good discipline. Legal risk is the risk of losses owing to fines and penalties on account of lawsuits. The various sources of legal risk can be summarized as follows. First, failure in subcontracting, that is, improper authorizations or execution. Second, failure in contract documentation, that is, mistakes in documentations. Although today we are using different types of softwares for maintaining all the documents, just like Word. Word is the best app or a software of Microsoft company, which provide us best different formatting systems. In that, we have the spelling checking also. We can check all the spellings. Okay, even we can set the dictionary language, whether it may be of United Standard or it may be of British Standard, means UK. Changes in law and regulations. Certain basic precaution can help to reduce legal risk. Authority. It is important to check that counterparties have the legal authorities to engage in trades. Insanity. There is always a possibility that clients may claim that the contracts were unsuitable to their needs or legal of expertise. Losing parties can claim financial insanity, that is, they were temporarily unable to judge financial contract. So standardized contract such as master netting agreements must be used to reduce the risk. Interrelationships. Legal risk often become intermingled with market and credit risks. Counterparties who lose money on account of market risk often resort to legal action to recover their losses. For example, P&G sued Bankers Trust in a well-documented case study. Procter and Gamble companies. Reputational risk can be viewed as the negative impact on the ongoing business due to a damaged reputations. Reputation is particularly important for financial institutions as the nature of their business requires maintaining the confidence of the market participants and regulators. If reputation gets eroded, there will be a run on the bank. In the case of some Swiss banks, the negative impact on reputation following the subprime crisis has led to substantial withdrawals of money by wealth management clients. Regulatory risks are the result of changes in regulations or interpretation of existing regulations. When regulation changes, business models and strategies also must change. A change in regulations can be threat to the current business model and effectiveness of the existing business strategy. Banking regulation is poised to undergo significant changes in the aftermath of subprime crisis. Political risks arise from actions taken by policymakers that significantly affect the way an organization runs its business. In such market, government policies tend to be personality centric. As such, the business climate is often characterized by a higher degree of uncertainty. In emergency market, political risk can take a form of nationalization, of imposition of various controls that put restrictions on the way business can be conducted. But even in developed countries, political risk should not be underestimated. A good example is the current controversy involving the US Internal Revenue Services IRS and the Swiss bank. We know many politicians kept their amount in Swiss banks. Okay, we also have few risks in our regular routines. If we are driving a car or we are going to office with our bike, okay, but if you are not regularly service your bike or car, what will be happen? It will be create few problems when you are driving on the road. Okay, so it's your duty to maintain your bike or car. Okay, regular servicing must be there. This is a small example of risk. The IRS has applied a lot of pressure on these banks to disclose sensitive client information. Means Swiss bank cannot give any information of their account holders. Okay, the controversy has arisen on account of how to interpret banking secrecy laws. The Swiss make a distinction between tax evasion and tax fraud, but the US any person not paying taxes as per the laws of the land is liable to be persecuted. There is a, however, little doubt that the current political climate, the Democrats are in change in the US, and the general anger against bankers has considerably aggravated the issue. In general, in developed countries, financial crises, losses often lead to call for legislative action. This is clearly the case today as legislators have threatened to impose various restrictions on the way bankers are compensated. Towards integrated risk management, the three ways of managing risk. In the word of risk, it is important not only for banks but also for non-banking corporations to manage risk strategically and holistically. Integrated risk management is all about the identification and assessment of the risk faced by a company as a whole, followed by the formulations and implementation of a company wide strategy to manage them. According to Lisa Melbrook, companies must learn to use the best combination of three complementary approaches to risk management, and that's are first is to modify the company's operation suitability. The second is to reduce debt in the capital structure. And the third is to use insurance or financial instruments like derivatives to transfer the risk. Take the case of environmental risk that a heavy chemical manufacturer faces. Modifying the company's operations could mean installation of sophisticated pollution control equipment. The company could also reduce debt and keep plenty of capital to deal with any contingencies arising out of environmental mishaps. The company can also achieve risk transfer by buying an insurance policy that would protect it is in case an accident occurs. An oil company needs a steady supply of petroleum crude to feed its refinery. Oil prices can fluctuate owing to various social, economic, and political factors. Indeed, they have done so in recent years. The company can set up or at least tie up with a large number of oil fields all over the world to insulate itself from volatility. This would limit the damage due to OPEC actions, terrorist strikes, or instability in Islamic countries. In case of a long recession, the best bet for a company would be to keep a minimum debt and maintain huge cash reserves. The company may also resort to buying oil futures contracts that guarantee the supply of crude at predetermined prices. A company like Walt Disney, which operates theme park, is exposed to weather risk. If weather is not sunny, people will not be turn up. So Disney took a decision to set up its second theme park in Florida. Today, the company can buy weather derivatives or an insurance policy to hedge the risk arising from inclement weather. A similar argument may well apply to the Board of Control for Cricket in India, that is BCCI. These days, with a big money involved, especially in the form of television rights, cricket matches are scheduled all throughout the year. So the threat of rain is real. If a match is washed off, the losses will be heavy. Okay. And the audience will be sad because of heavy rains on the ground, on the cricket ground. BCCI has two options. It can stick to the cities where there is a little rain in the long run. Okay, this is the solution. Means where is rainfall is in very less. It can even explore the possibility of indoor stadia, but it is not possible. This is the operational solution. Alternatively, BCCI can take insurance cover. This is the risk transfer approach. Matches always get cancelled because of heavy rains. Okay. So these types of risk also can be transferred with the help of insurance because there are heavy maintenance expenses to arrange match on the another day. The software giant Microsoft operates in an industry where technology risks are high. The company manages risk by maintaining low overheads and zero debt. But Microsoft also has organizational mechanism to deal with risk. The capacity of a software company is effectively the number of software engineers on its payroll. Excess capacity can create serious problems during a downturn. Right from the beginning, Microsoft founder Bill Gates was particular about not employing more persons than required. So, Microsoft has always maintained a lean staffing depending on temporary workers to deal with surges in workload from time to time. This not only reduces the risk associated with economic slowdown, but also results in greater job security for its core group of most talented workers. In contrast, many Indian software services companies have traditionally maintained a huge bench. This became a major liability during the recent downturn fueled by the financial crisis. My suggestion to all, when you are working in a company and you find that you are stable now in that company and you have to buy flats, car, okay, but you must have to think about layoff also. If company arrange layoffs, there will be situations that you will be relieved from that company. So before to take any actions about to take any property, just like car, flats, or plots, so you should have to arrange another sources of income that will be useful to repay the installment of your loans. Your EMI should not be stopped. India's well-known software services company Infosys maintains plenty of cash. Infosys believes cash gives a lot of comfort in a volatile industry characterized by swift changes in technology and shift in client spending patterns to sustain operations under adverse conditions and make investments in marketing and R&D. Infosys depends heavily on equity and keeps little debts on its balance sheet. Airlines can manage their exposure to fluctuate oil prices by taking operational measures to cut fuel consumption. This might involve better maintenance of the aircraft or purchase of more fuel efficient engines. Another option is to buy financial instruments such as futures to hedge the risk. This is the risk transfer approach. Transfer solution such as derivatives or insurance may be more efficient than organizational solutions. The ultimate strategy for the rainy days in to keep overheads and debt low and hold plenty of cash to tide over uncertainties about which manager have little idea today. Indeed, equity is an all-purpose risk cushion. The larger the amount of risk that cannot be identified, accurately measured, or quantified, the more the equity component should be. It is no surprise that technology companies like Microsoft and Infosys keep little or no debt on the balance sheet. Of course, equity is the more expensive sources of fund. Equity holders expect a much higher rate of return compared to debt providers, but that might well be a small price to pay in a volatile business environment. During a severe downturn, a comfortable capital position can give a company a major competitive advantage. Due to power failure, Wi-Fi is off. So let me to start again. Am I audible now? Am I audible?
Yes, sir.
Okay, nice.
Yes, sir.
Long-term capital management, LTCM controlled its market risk by pursuing what are called convergence trades in bond markets. LTCM would no go long in one set of financial instruments and short in another related set. The yields would, under normal circumstances, coverage with time enabling LTCM to look profits. Unfortunately, in 1998, the market condition became abnormal. The assumptions behind the hedge funds sophisticated models became unrealistic. Yields started diverging instead of converging. Following worries among investors about the stability of emerging markets in the aftermath of the Asian currency crisis and the plunge of the ruble in Russia. LTCM's positions were fundamentally sound, but the fund did not have the liquidity to hold on till the situation improved as it suffered losses on its positions. LTCM had to make margin calls when it tried to raise capital. There were few takers. With insufficient liquidity, LTCM went bankrupt and had to be bailed out under a Federal Reserve sponsored plan. What actually happened was the market risk became liquidity risk. In the 1980s, many American banks gave dollar denominated floating rates loans to countries risk Mexico and Brazil to eliminate market risk or more especially exchange rates and interest rates. When interest rates in the US skyrocketed during the tenure of Federal Reserve Chairman Paul Volcker, who was fighting a fierce battle against inflation then, and the dollar appreciated. There are major defaults. In short, market risk was transformed into credit risk. Legal liabilities for injuries. The variety of potential magnitude of personal and business liability exposures have increased tremendously in the past 30 years. Firms now are subject to liability risk in almost every aspect of their operations. For example, liability can arise from employment practices in addition to employer responsibility for paying workers, compensation benefits to injured workers. Second, products sold to consumers. Third, the disposal of waste or use of toxic chemicals. And four, the actions of corporate boards or directors. The evolution of the US liability system has been subject to substantial controversy and debate. This session provides an introduction to the legal liability system that is necessary to understand issues related to legal liability risk. Many of the subsequent chapters require some understanding of the legal liability systems. We summarize the two main Types of law, common law, and statutory law. Common law refers to the law that has evolved over time as a result of previous court decisions. It has not been enacted by a legislative body. The rule of precedent, which states that the court generally should follow the logic and ruling of prior court decisions, is the source of common law. In contrast, statutory law refers to the law that have been passed by a legislative body, such as state legislature or the US Congress, and then signed into law by the executive branch, a governor or president. Although there are important exceptions, much legal liability is based on common laws. As shown, law also can be categorized as either criminal or civil. Criminal law, which is usually the result of statutes, covers acts against the states and individual state or local government or the federal government. For example, since murder is contrary to the public interest, it is considered to be an act against the state and it's therefore a violation of criminal laws. In contrast, civil law deals with acts that cause losses to another individual, but for which the state, the public at large, has the less direct interest. There are, in turn, two branches of civil laws: contract law and tort law. Means you should have to understand what is criminal law and what is civil law. Criminal law means the cases of hampering one person by another person's, means types of murder cases, okay, snatches, theft, theft cases, and other robbery cases. These are criminal cases. And what about civil cases? Civil cases are that cases related to our property, trust, organizations, okay, miss mismanagement of documentation or breach of agreements. These types of laws are in civil laws. Contract law interprets contractual provisions and resolve disputes between contractual parties, such as when one party is harmed as the result of another party's failure to fulfill its contractual obligations. Parties found liable for breach of contract must pay monetary damages and, in some instances, perform their obligations under the contract. Tort law deals with wrong done to someone where a contract does not govern the interaction that caused by the harm. Parties held liable for injuries under tort laws must pay the injured party monetary damages. For example, if an automobile hits and harms a pedestrian, the driver and the pedestrian do not have a contract to help them determine how the interaction will be handled. Therefore, tort law handles the issue of who is responsible for the damages. Means this is one type of civil law case. In contrast, if an automobile dealer fails to deliver a car to a buyer at an agreed upon date and a result the buyer suffers monetary losses, the issue of who is responsible for the damages is handled under contract law. The focus of this session is tort law. Unless otherwise noted, the term liability refers to tort liabilities. Tort liability rules and procedures. There are various ways of assigning liability for losses that arises from the interactions among parties who do not have contractual regulations. As an example, consider the losses, medical costs suffered by a pedestrian who has been hit by an automobile. The law could make the pedestrian responsible for his or her own losses regardless of the circumstances of an accident. Alternatively, the law could make the driver responsible for the pedestrian losses regardless of the circumstances of the accident, or an intermediate approach could be taken whether the law examines the circumstances of accidents and decides who should be responsible for the pedestrian medical expenses. The law must allocate responsibility for the other potential losses suffered by the pedestrian, much as lost wages, mental anguish, and the like, as well as decide who is responsible for the driver's losses, if anywhere suffered. Regulatory risk related to operational risk. The management of operational risk in the banking industry has undergone dramatic changes over the last decades due to substantial changes in the operational risk environment. Globalization, deregulation, the use of complex financial products, and changes in information technology have resulted in exposure to new risk very different from market and credit risk. In response, the Basel Committee on Banking Supervision (BCBS) has developed a regulatory framework referred to as the Basel II Accord (BCBS 2006) that introduced the operational risk category and corresponding capital requirements against operational risk losses. The Basel II Accord (BCBS 2006) defines operational risk as the risk of loss resulting from inadequate or failed internal processes, people and systems, or from external events. This definition indulge legal risk but exclude strategic and reputational risk. The Basel III Accord, which will be implemented piecemeal until 2019, has no explicit changes to the operational risk framework but focuses on comprehensive and dynamic capital risk and liquidity management that cannot be achieved if operational risk is not well managed. The International Actuarial Association has adopted the same definition of operational risk in the capital requirement for insurance companies referred to as Solvency II. Similar developments also took place in the pension fraud industry. For example, the Australian Prudential Regulation Authority (APRA) Prudential Standard 114 introduced the operational risk capital requirement for pension funds starting from July 2013. Operational risk was the third major risk category coming under the Basel Accord framework following market and credit risk. A conceptual difference between operational risk and market to credit risk is that operational risk represent a downside risk with no upside potential. The term operational risk started to be used within financial institutions after the Bearing Bank after events in 1995 when a rogue trader caused the collapse of the Term operational risk started to be used in the industry to define situations where such losses could arise. Operational risk is important in many financial institutions. Example of extremely large operational risk losses are Bearing Bank in 1995, when the actions of the rogue traded usually bankruptcy as the result of GBP 1.3 billion derivatives trading loss. Enron's bankruptcy in 2001 as a result of actions of its executive with USD 2.2 billion loss. Society General losses of euro 0.4.9 billion in 2008 due to unauthorized trades, and Knight Capital Corporation losses of USD 450 million within 30 minutes in 2012 due to a software glitch after installing new high frequency trading software. The Basel Committee does not possess any formal supervisory authority, and its conclusions do not have legal force. It formulates broad supervisory standards and guidelines and recommends statements of best practice in the expectations that individual authorities will take steps to implement them through detailed arrangements that are best suited to their own national systems. In this way, the committee encourages convergence towards both common approaches and standard without attempting detailed standardizations of supervisory techniques in member countries. In Australia, all major banks have already received Advanced Measurement Approach AMA accreditations for operational risk starting from 2008. In 2012, a capital against operational risk in major Australian banks ranged from AUD 1.8 to 2.5 billion, 8 to 10% of the total capital. Rapid progress in the development of quantitative methodologies for estimating operational risk capital under the AMA within major banks in Australia can be attributed to the choice by APRA to link AMA in operation risk to the internal ranging based approaches in credit risk. Regulatory approaches for operational risk. The Basel II and Basel III Accord framework is based on three conceptual pillars. Pillar 1, minimum capital requirements. This pillar requires an explicit minimum capital allocated for operational risk that can be calculated using different approaches. Pillar 2, supervisory review process. This pillar focuses on the supervision of bank systems and capital adequacy by regulatory authorities. Pillar 3, market discipline. The objective of this pillar is to establish market discipline through public disclosure of risk measures and other relevant management. In this session, we focus on pillar 1 and reviews some probabilistic models for operational risk. Many models have been suggested for modeling operational risk under Basel II. In brief, two conceptual approaches are the so-called top-down. For example, multi-factor equity pricing model, the capital asset pricing model, CAPM, and income or expense based model, and bottom up approach, process based models such as causal networks, multi-factor causal models, reliability model, and loss distributions approach models. Under the top down approach, estimating the risk for firms is based on macro data such as gross income or analyzing overall company losses. Under the bottom-up approach, the risks are quantified at the local level. For example, process level, event types, business units, or business line, event type, risk cells, and aggregated to find the risk for the whole firm. Under the Basel II Accord framework, three approaches can be used to quantify the operational risk annual capital charges. PCBS 2006, the basic indicator approach BIA, standardized approach SA, and advanced measurement approach AMA, internationally active banks and banks with substantial operational risk exposures. For example, specialized processing banks are expected to use the AMA. The basic indicator approach, the BIA, is the simplest method under the Basel II Accord framework to calculate the capital against operational risk, where the capital is calculated. Sources of legal and regulatory risk, regulatory changes, new laws, amendments in existing laws, violations of labor laws, non-payment of taxes, breach of corporate governance norms, contractual risk, poorly drafted contracts, breach of contracts, dispute with suppliers or customers, or litigation risk, lawsuit by customers, employee disputes, shareholders litigations, licensing and permit risk, cancellation of licenses, delay in approvals. Six, international law risk, different legal systems in global operations. What are the impacts of legal and representative risk? Heavy fines and penalties, business disruptions, loss of reputations, loss of license to operate, increased compliance, cost, criminal liability of management, decline in investor confidence. Legal and regulatory risk management measures, strong compliance framework, compliance policies, internal controls, legal audits. Second, legal risk assessment, periodic legal review, risk registers. Third, contract management system, that is standard contracts and other legal weightings. Regulatory monitoring, tracking changes in laws, government notifications. Five, training and awareness, employee training on legal requirements. Six, corporate governance, audit committee and risk committee. Seven, insurance director and officers, D&O, insurance, professional liability insurance. Example of legal and repository risk, environmental law violations causing factory closure, tax penalty for non-compliance, SEBI penalty on a company, violation of data protection law, product liability risk, meaning product liability risk refers to the risk that arises when a company is held legally responsible for injury, damage, loss caused by a directive product. It occurs when products fail to meet safety or quality standards. Product liability risk in enterprise risk management refers to the potential financial, legal, and reputational losses an Organizational faces if its product cause harm to consumers, property, or the environment. It arises when a company is held responsible for defects, safety issues, or inadequate warning associated with its product. Definitions of product liability risk. Product liability risk, the exposure to lawsuits, regulatory penalties, recalls, or reputational damage due to defective or unsafe products. It is especially relevant in industries like manufacturing, pharmaceuticals, food and beverages, automatic and consumer electronics. Sources of product liability risk, design defects, flaws in the product, designs that make it inherently unsafe, manufacturing, manufacturing defects, error during production on that lead to faulty products, marketing defects, inadequate instructions, labeling errors, or failure to warn consumers of risk, regulatory non-compliance, non-meeting safety standards set by authorities, for example, FDA, BIS in India, supply chain issues, defects introduced by third-party suppliers to contractors. Example, a car manufacturer facing lawsuits due to faulty airbag. So many car companies call back their cars which has defect, and company has given a substitute car uh, for the use of their consumers, and they have made these changes without any extra cost. Same thing is happens in two-wheeler company also. If consumer found there is a default, which is a manufacturing default, and which is recommended by all the consumers or customer to the company, then company will recall all the bikes back to the company to resolve the issue, defect issue, because it will hamper the brand and legal association of the company. Other example of a pharmaceutical company sued for side effects not disclosed in drug labeling. We found in India a drug company which is not providing proper drugs for cup problems and has contaminated with chemicals, and due to that contaminations publics are affected with different types of diseases. So the product is totally banned by the government. A food company recalling product contaminated with harmful bacteria, means we know about Maggi noodles. There were be few comments on Maggi noodles that it has a lead property, and due to lead property, it is harmful to our human health, and that's why so many peoples are avoiding to eat Maggi noodles instead of to prepare homemade noodles. A toy manufacturer penalized for producing unsafe toys or that pose choking hazards, means small children always like to choke the toys, and it may be harmful to health of that child. Managing product liability risk in ERM, quality control systems, rigorous testing and inspection during design and manufacturing, compliance programs adhering to industry standards and government regulations, clear labeling and warnings, providing accurate usage instructions and safety warnings. On the tobacco products, there is the instructions. What is that instructions? Tobacco is harmful and it may be a reason of producing diseases like cancer. But people are already consuming that product, although instructions are there. Cigarette is also the example of becoming a cancer patient. Insurance coverage, product liability insurance to cover claims and lawsuits. Suppliers audits, ensuring vendors meet quality and safety standards. Recall procedures, having a structured plan to quickly remove defective products from the company. Continuous monitoring, tracking customers' feedbacks, complaints, and product performance. Type of product defects, design defects, manufacturing defect, marketing warning defects. Sources of product liability risk, poor quality control, safety failures, improper testing, incorrect instructions. Regulatory non-compliance. 6. Supply chain risk, impact of product liability risk, compensation claims, production recalls, legal cost, loss of brand reputations, declines in sales, customer trust erosions, regulatory sanctions. Product liability risk management measures, quality control, and assurance. Second, product testing. Third, clear labeling instruction. For supply evaluation. For product recall system. 6. Customer feedback system. 7. Product liability insurance. 8. Legal compliance. Example of product liability risk: defective automobile part causing accidents, expired medicinal harming patients, electrical appliances causing fire, contaminated food product. Role in enterprise risk management, legal and regulatory risk and product liability risk are identified enterprise-wide, assessed using probability impact matrix, controlled through policies, procedures, and insurance, reported to top management, linked with business strategy. Comparison given legal and reputation risk, product liability risk. Legal and regulatory risk and product liability risk are critical enterprise risks that directly affect the credibility and sustainability of an organization's effective risk management through compliance systems, quality control, insurance, and government governance helps organizations minimize losses, protect customers, and enhance corporate reputations. And thank you. The session is over.